So what if the biggest financial trap you face isn't actually how much you earn,
Right.
but the actual physical route your money takes once it enters your life?
It's a huge question.
It is. I mean, think about the cash sitting idle in your checking account right now. You probably view it as a safety net, like a
Yeah.
cushion.
Yeah, exactly. A comfort zone.
But what if that idle cash is secretly costing you hundreds of thousands of dollars in mortgage interest?
It's wild because it challenges a very deeply ingrained belief system we have. I mean, we are conditioned from a very young age to focus almost entirely on our top line revenue.
Right, like what's my salary?
Exactly. We obsess over our salary, our hourly rate, the gross income on our tax returns, but we spend almost no time analyzing the actual mechanics of cash flow.
We just ignore the plumbing.
We do. We treat checking accounts as these safe, neutral holding zones. But the reality of modern banking is that a traditional checking account is structurally designed to trap your wealth, not grow it.
And that is the core premise we are unpacking today on this deep dive.
It's going to be a fascinating one.
We were exploring a completely different paradigm for home financing and cash management. We're looking at a structure called the all-in-one loan, or the AIO, which was originally pioneered by CMG Financial.
Right.
To get to the bottom of this, we've pulled together technical underwriting brochures, historical performance data over the last decade, and a really strategic masterclass from Ricky K. Miss, the president of Epic Lending.
And the goal here, the mission, is we are going to completely deconstruct the actual mathematics of traditional debt.
Yes, the numbers.
We'll look at the exact anatomy of this AIO structure and why it fundamentally alters the timeline of a mortgage. But, we aren't stopping at the theory.
No, we have to see how it works in real life.
Exactly. We need to run through specific day-by-day scenarios of how this accelerates wealth for variable income earners and business owners.
And then we're going to examine the broader toolkit that strategic lenders use to circumvent the traditional bottlenecks of buying and selling real estate.
It's a lot of ground to cover.
It is. But to understand the solution, we first have to understand why the current system is just fundamentally broken for the consumer.
Right.
When you pull back the curtain on a standard 30-year fixed-rate mortgage, you realize it is a product designed for an economy that doesn't really exist anymore.
Yeah, the 30-year fixed amortized loan became the standard back in the mid-20th century. And honestly, from the bank's perspective, it is a masterpiece of financial engineering.
For them, yeah.
Exactly. But for the modern consumer, who often has diversified investments or maybe variable income, or just a desire for financial efficiency, it is incredibly sluggish.
Sluggish is a good word for it.
Well, the most glaring issue with amortization is that the interest is heavily front-loaded.
Let's put some numbers to that so we aren't just talking in abstractions.
Yeah.
If I take out a standard mortgage today, what does that front-loading actually look like in the first few years?
Okay, let's say you borrow $500,000 at a 7% interest rate on a 30-year fixed term.
Okay, pretty common scenario.
Right. Your monthly principal and interest payment is going to be roughly $3,300.
Got it.
In month one, out of that $3,300, nearly $3,000 goes straight to the bank as interest.
Wait, really? Almost the whole thing.
Yeah, you are paying down maybe $300 or $400 of the actual principal balance you owe.
So I write a check for over $3,000, and my actual debt only goes down by a few $100. That's painful to hear.
It is, and this ratio stays heavily skewed toward interest for years. It isn't until you are more than a decade into the loan that a meaningful portion of your monthly payment starts attacking the principal balance.
So the bank basically ensures they get their profit up front.
Exactly. And the other side of that trap is the complete lack of liquidity.
Right.
Let's say you get a year-end bonus of $20,000 and you want to be responsible. You want to attack that principal.
Makes sense.
But if you write a check for $20,000 and send it to your mortgage servicer, that money is now locked away.
It's gone.
It's a closed-end system. You can't get that money back if you suddenly have a medical emergency or, say, your roof caves in.
Right. Unless I go back to a bank, apply for a home equity loan, pay all those closing costs, and basically ask for my own money back.
Which creates a massive psychological barrier,
Well, absolutely.
The traditional system essentially penalizes you for trying to get out of debt early by stripping you of your liquidity. People recognize that risk instinctively.
So what do? They keep their cash out of the mortgage and stockpile it in a checking or savings account?
Exactly.
As you're explaining this, I keep picturing Like a leaky bucket and a locked vault.
Oh, that's a great analogy.
Right. Our standard checking accounts are essentially leaky buckets. The money just sits there, losing purchasing power to inflation, earning a fraction of a percent if we're lucky.
If you're very lucky.
Yeah. Meanwhile, our traditional mortgage is this locked vault.
Yeah.
We let the bank use our idle checking deposits, the money pooling in our leaky buckets, to lend out and make themselves wealthy, while we are slowly bleeding out 30 years of interest over in the locked vault.
The leaky bucket and the vault is a perfect way to visualize it. It touches on a crucial macroeconomic principle called the velocity of money.
Okay, velocity of money. Break that down.
In the traditional structure, your income and your debt live in completely isolated silos. You have your banking over here and your financing over there.
Right. Two totally different worlds.
Exactly. You receive your income, it lands in the checking account, and once a month, you carve off a piece of it and send it away to the mortgage servicer.
We even use that language. I have to send in my mortgage payment.
Right. You are sending it away. And whatever is left over, your discretionary cash, your emergency fund, the money you're saving for a vacation 6 months from now, it just sits in that checking account. Totally unproductive.
Doing absolutely nothing.
The traditional system thrives on this isolation. It relies on your money doing absolutely nothing for you, so the institution can use it to do something for them.
So the logical conclusion is that if the system wins by isolating our income from our debt, the only way to beat the system is to just smash those two worlds together.
That is exactly it.
And that brings us to the actual architecture
Right.
of the all-in-one loan.
Right. The AIO essentially fuses two distinct financial products into one entity. It's a first lien home equity line of credit, or a HELOC, and an FDIC-insured checking account combined.
Wow.
CMG Financial launched this model in the U.S. back in June 2005. They actually took inspiration from very common, highly successful offset mortgage models used in Australia, New Zealand, and parts of Western Europe.
So it's not a brand new, untested concept globally?
Not at all. It's a 360-month term, so 30 years, but it is open-ended.
Okay, wait. I need to pause here because this is where my brain starts to short-circuit a little bit.
Sure.
When you say the checking account and the mortgage are fused, do you mean I'm doing my daily banking inside my mortgage?
Yes.
Like if I go to the grocery store, buy a carton of eggs, am I technically taking out a second mortgage on my house?
It sounds alarming when you frame it that way, but yes, functionally, your primary banking occurs within the credit facility of the home.
That is wild.
It comes with ATM and Visa debit cards. You have a $1,000 daily cash withdrawal limit, point-of-sale purchase limits between $2,500 and $5,000, depending on the tier.
So this feels like a normal bank account.
Exactly. You have bill pay, ACH transfers, direct deposit, mobile banking. It operates invisibly, exactly like a normal checking account.
But doesn't tying your daily routine spending to your home's equity feel incredibly risky? I feel like the average person would be terrified of accidentally, I don't know, spending their house away.
That reaction is completely normal because we view debt through the lens of the traditional closed-end system.
Right, the vault.
To understand why this isn't risky, but rather a huge wealth accelerator, we have to look at the engine of the AIO.
Okay, what's the engine?
It's the nightly sweep and daily interest computation.
Okay, let's break down the mechanics of the nightly sweep. How does my paycheck actually interact with my mortgage balance?
In the standard AIO program, you set up your direct deposit so your paycheck lands in this integrated checking account.
Makes sense.
Every single night, at midnight, the system automatically sweeps every dollar of positive cash you have and applies it directly to the HELOC's unpaid principal balance.
Let me be sure I've got this. So
Right.
if I owe $300,000 on the home and my paycheck of $5,000 lands in the account, the next morning my loan balance is automatically $295,000.
Yes, exactly. But here's the critical part.
Okay.
With a traditional mortgage or a standard HELOC, the bank calculates your interest based on your average monthly balance or an amortized schedule.
Right.
But with the AIO, interest is computed daily based on the unpaid principal balance after all your credits and debits for that specific day have been processed.
Oh, wow. So at 11:59 p.m., the system looks at exactly what I owe at that precise second.
Yep.
And it only charges me interest on that exact amount for that one day.
Exactly. And this is why sweeping your income directly into the loan is so powerful. That $5,000 paycheck you deposited immediately acts as a weapon against the principal.
Because it lowers the balance before the math is done for the day.
Precisely.
Yeah.
And because the interest is calculated daily, driving down the balance immediately drives down the daily interest charge.
Okay. Let me make sure I'm fully grasping the timeline here because this is huge. Let's say I deposit that $5,000 on the first of the month.
Okay.
And I know I have a massive property tax bill of $3,000 due on the 25th.
Sure.
For those 24 days in between, my money isn't just sitting in a leaky bucket earning 0%.
Not at all.
It is actively suppressing the principal balance of my mortgage, saving me interest every single night.
That is the exact mechanism. Your idle cash is put to work the second it enters your ecosystem.
That's brilliant.
And when the 25th rolls around and you need to pay that tax bill, you just write the check or use the bill pay feature. The system draws the $3,000 back out of the available line of credit.
So the money was always completely liquid, always accessible?
Exactly. But it spent 24 days saving you mortgage interest at a rate of 6 or 7%.
That is a massive paradigm shift.
Yeah.
But I want to stop and clarify a technical term I saw in the source materials.
Yeah, what's that?
The notes mention that the interest rate on the AIO is calculated using an index plus a margin. For someone who only knows about a standard 30-year fixed rate of, say, 6%, how does this indexed rate actually work?
That's an important distinction. The AIO is an adjustable rate product. It is tied to a major financial index.
Like what?
Historically, this might be the prime rate or something like the secured overnight financing rate, which is known as SOFR.
Okay, SOFR.
The index is the baseline cost of borrowing money in the broader economy, which fluctuates based on central bank policies.
Okay, so that's the baseline. And the margin?
The margin is the fixed percentage added on top of that index by the lender to cover their costs and, profit.
Got it. So give me an example.
So if the index is currently at 4% and your specific loan agreement has a margin of 3%, your effective interest rate for that day is 7%.
And as the index moves up or down over the years, your rate adjusts accordingly.
Exactly.
Which usually terrifies people. I mean, the phrase adjustable rate mortgage brings up terrible memories of the 2008 financial crisis.
Oh, absolutely.
If the rate can float up, doesn't that wipe out the benefits?
The fear is totally justified based on history, but the mechanics of the AIO neutralize much of that risk.
Oh, so.
Because of the daily interest computation and the constant sweeping of your entire income against the principal, the balance drops so rapidly that it outpaces the mathematical impact of a rising rate.
Oh, interesting.
Yeah, even in a rising rate environment, borrowers often pay significantly less total interest because their principal balance is plummeting month over month.
Right. Who cares if the rate goes up a little if the amount you owe is half of what it used to be?
Exactly.
Before we move on to the actual simulations, there was a really specific carve-out in the notes regarding the state of Texas. It seems like the automatic sweep we just talked about doesn't apply there.
Yes, that's a crucial regulatory nuance. Texas has incredibly strong consumer protection laws.
Right.
Specifically, the Texas Constitutional Article 16, Section 50 rules, often referred to as A6 rules.
A6 rules, okay.
These laws are designed to fiercely protect a homeowner's primary residence, their homestead, from certain types of creditors and forced sales.
Which is a good thing for homeowners.
It is. But because of these protections, tying a checking account to an automatic sweep against a home equity line is prohibited.
Oh, so if you live in Texas, you just can't get this loan.
No, you can still get it, but the architecture of the Texas Homestead All-in-One program is slightly modified to comply with state law.
Okay, how does it work there?
Instead of the system automatically sweeping your deposits at midnight, the deposits stay in your checking account. The borrower then manually logs in and transfers whatever funds they don't need for near-term expenses over to the HELOC side.
I see. So it requires a bit more active management on the part of the homeowner.
Yeah.
They have to physically move the money to get the interest suppression benefit.
Correct. But the financial philosophy and the mathematical outcome remain identical.
Right. The math is the math.
Whether the computer does it automatically or you do it manually on a Tuesday morning, the goal is moving idle cash against your debt to shrink the daily interest calculation.
Okay, understanding the mechanics in a vacuum is one thing. But honestly, it still feels a bit abstract. I want to see how this math behaves in the wild.
Let's do it.
Let's dig into the real-world velocity and financial simulations provided by Ricky K. Miss and Epic Lending.
Yeah, CMG Financial uses an interactive comparison simulator.
It's simulator.
Right. It's a proprietary software tool they use to stress test every single applicant scenario before they ever approve a loan.
Wow, so they actually test it for your specific situation.
Exactly. They want to ensure there is a mathematical net tangible benefit for the borrower. And the baseline scenario they provided in the source material is staggering.
Let's walk through those exact numbers.
Okay.
We have a hypothetical homeowner who is currently 39 months into a traditional 30-year fixed-rate mortgage.
Right.
They have a remaining balance of $226,750.
Okay.
They locked in a great traditional rate of 5%. The simulator compares keeping that traditional loan against moving to the AIO. And the AIO in this scenario has a margin of 3.5% over the index.
Right. So the simulator takes their stated monthly income and their stated monthly expenses and runs a chronological day-by-day algorithm.
So it's simulating normal banking activity flowing through the AIO.
Precisely. And the results are profound. By simply changing the flow of their money, the payoff timeline drops from 26.8 remaining years down to exactly 12 years.
That is almost 15 years of mortgage payments completely erased.
Yes, just gone. And the raw interest saved is $49,132.
That's a new car.
It is. But the true power is the wealth accumulation forecast.
Let's break that down, because paying off the house is great, but where does the wealth accumulation number come from?
Think about the cash flow. Once the house is paid off in year 12, this borrower no longer has a mortgage payment.
Obviously.
So the simulator assumes that for the remaining almost 15 years, the time they would have been paying the traditional mortgage, they take that exact same monthly cash flow and redirect it into a standard investment vehicle.
Oh, because they're used to spending that money anyway.
Exactly. The total wealth accumulation with the AIO strategy hits over $1.18 million.
Wow.
Compared to just $848,000 if they had stayed in the traditional loan.
That is a difference of over $330,000 in net worth.
It's incredible.
And they didn't have to get a second job. They didn't have to win the lottery. They just changed the plumbing of how their paycheck interacts with their debt.
Precisely. But the simulator is just a baseline. To really understand the utility of this, we need to look at the specific examples highlighted in the EPIC lending strategy materials.
Right, because not everyone has a perfect, predictable paycheck.
Exactly. The traditional mortgage assumes everyone gets a perfectly consistent paycheck every 2 weeks, but that's not how the modern economy works.
Let's take the realtor example from the materials. Real estate agents, freelancers, commission-based sales reps, their income is highly variable.
So let's map out a 60-day cash flow cycle for a successful real estate agent. Let's say her name is Sarah.
Okay, Sarah the realtor.
In January, the market is slow. She closes 0 deals and brings in no commission.
Very realistic.
But in February, she closes 2 huge properties and gets handed a massive commission check for $25,000.
Okay, so under the traditional system, Sarah takes that $25,000 check and drops it into her business checking account.
Right.
She knows she might not see another big check until May, so she is terrified to part with that cash.
Yep, she needs a safety net.
She leaves it entirely in checking because she needs liquidity to survive the dry months. She pays her standard $2,000 mortgage payment, and the remaining $23,000 sits in her leaky bucket, earning nothing.
Exactly.
Meanwhile, the bank is charging her daily interest on her massive mortgage balance.
The traditional system forces her to choose between liquidity and debt reduction, but watch what happens with the AIO.
Okay, what does Sarah do now?
Sarah drops that $25,000 commission check into the AIO checking account on February 1st. That night, the entire $25,000 sweeps against her principal balance.
Wow. Her mortgage debt instantly drops by $25,000.
Yes.
But she still needs to live. She has groceries, gas, marketing expenses for her listings.
Exactly. Let's say over the course of February, she spends $10,000 on living and business expenses.
Okay.
Every time she swipes her debit card, the AIO line of credit edges back up. But the timing is everything.
How so?
That $10,000 she eventually spent didn't leave the account on February 1st. It left gradually over 28 days.
Oh, I see.
For the days that money sat in the account, it was violently suppressing her principal balance, shrinking her daily interest charge. The money is literally working for her while she sleeps.
And more importantly, she has total peace of mind. She isn't anxious about locking her money in a vault.
Right.
If March rolls around and she needs $5,000 for an unexpected tax bill, she just writes a check. The flexibility seems unparalleled.
It fundamentally changes the psychology of variable income. Now let's look at the business owner example.
This was a good one.
This is perhaps an even more dramatic illustration of opportunity cost. A business owner often needs significant cash reserves sitting idle.
Yeah, for emergencies.
Let's say a local restaurant owner keeps $80,000 in cash reserves just in case an oven breaks, payroll gets tight, or there's an unexpected supply chain issue.
In a traditional setup, that $80,000 is dead weight. It sits in a commercial checking account.
Right.
If the business owner has a mortgage at a 7% interest rate, it is agonizing to look at that 80 grand doing nothing. But
Yeah.
they can't put it into the traditional mortgage.
No, because if they send it to the bank to save on interest, the money is gone.
Exactly. If the restaurant's walk-in freezer dies the next morning and they need 20 grand immediately, they can't get it back without applying for a loan and waiting weeks for underwriting.
But with the AIO, that $80,000 naturally sits within the HELOC facility. It acts as a massive anchor on the principal balance.
So it's basically canceling out $80,000 of their debt for interest purposes.
Exactly. It is compounding interest savings month over month at the rate of the loan. It's effectively earning the business owner a guaranteed 7% return on their cash by avoiding the interest charge.
But it's still completely liquid.
Entirely liquid. If the walk-in freezer dies on a Sunday morning, the owner just uses the AIO debit card or wires the funds to the repair company.
That is just so efficient.
The money serves dual purposes simultaneously. It is both an impenetrable emergency reserve and a primary wealth accelerating tool. The opportunity cost of idle capital is completely eliminated.
Okay, looking at the math and these scenarios, there is a very glaring question that has to be asked.
I bet I know what it is.
This product is so mathematically superior, why doesn't literally every homeowner in the country have one?
That's a fair question.
When you read through the underwriting guidelines, the catch becomes pretty obvious. It comes down to qualification standards and financial psychology.
Right. The AIO is not a magic wand, and it is absolutely not for everyone. The qualification standards are rigorous, and rightfully so.
Why so strict?
Because it is an open-ended credit facility tied to a checking account, the lender is taking on a unique risk profile. To even be considered, borrowers need a minimum FICO score of 700. They have a maximum allowed debt-to-income, or DTI, ratio of 43%, and they must have a minimum reserve requirement of 10% of the line of credit amount.
The source material actually included a demographic breakdown of the average AIO borrower.
Yeah, based on over 8,000 loans funded by CMG Financial between 2018 and 2023.
And frankly, the profile is highly affluent. The average borrower is 50 years old. They have an annual income of $245,256.
Which is significant.
They possess over $307,000 in documented liquid assets. Their average FICO score is 766, and their DTI is just 33%.
Furthermore, the loan amounts are massive. The product finances up to $3 million for primary and second homes, and up to $1 million for investment properties.
Let's pause here. If I'm listening to this, my immediate reaction is, okay, this is just a rich person's loophole.
Sure, it sounds like that.
It's a tool for people who already have money to keep more of their money. And honestly, if you give someone access to a $3 million line of equity tied directly to a plastic debit card in their wallet, doesn't that require an insane amount of human discipline?
Yeah, people worry about that.
What's stopping someone from having a midlife crisis and swiping their house away on a sports car?
It is a very valid concern, and it's the most common pushback this product receives. But the historical data tells a fascinating story that directly contradicts that fear.
What does the data say?
CMG Financial reports a historical performance of 0 defaults on this product. 0.
Wait, 0 defaults. On a home equity line, acting as a checking account over a multi-year period, that is wild.
It is statistically remarkable, and the reason behind it addresses your point about discipline. The AIO actually does not require new discipline.
What do you mean?
It relies entirely on the borrower's existing budget and spending habits. The simulator requires households to have at least 10% residual income to be considered candidates.
Oh, meaning at the end of the month, they naturally spend less than they make.
Yes. So if you are someone who lives paycheck to paycheck or consistently spends more than you earn, this loan will actually accelerate your ruin.
Wow. Okay. That makes sense.
Exactly. If you have negative cash flow, sweeping it into a HELOC won't save you. But if you are already living within your means and generating positive cash flow, whether you make $80,000 a year or $800,000 a year, you don't have to change your lifestyle one bit.
You don't have to eat out less. You don't have to skip vacations.
No, you are simply changing the flow of the money you already make.
CMG also enforces a very specific operational step before the loan ever funds to ensure people don't misuse it, right?
Mhm.
The quality assurance call.
Yes. This is a mandatory step.
Wow.
Before any loan documents are issued or funded, an underwriter conducts an extensive quality assurance call with every single applicant.
What happens on the call?
They walk through the closing process, how to activate the account, and the mathematical best practices for use. They verbally ensure the borrower understands that every time they swipe that debit card, they are increasing their loan balance.
So they make sure you really get it.
Exactly. It mitigates institutional risk and ensures the borrower is stepping into a strategic wealth tool, not treating it like a blank check.
Because it requires such a specific mindset, a strategic mindset rather than a transactional one, it completely shifts the role of the mortgage professional.
It really does.
The loan officer can't just be an order taker. If they're dealing with these tools, they have to act as a wealth advisor.
Which brings us to the broader scope of our deep dive. The AIO is brilliant for high cash flow individuals, but what about the rest of the market?
Right.
What about the entry-level buyer or the seller trapped in a stagnant market? This philosophy of strategic financing requires a broader arsenal of tools, which is why we are looking at brokerages like Epic Lending.
Ricky Camus and the team at Epic Lending leverage CMG Financial's exclusive products, but they apply this strategic problem solving across the entire spectrum of real estate.
Yeah.
Two proprietary tools in their arsenal stood out in the source material as complete game changers: Home Fund It and List and Lock.
Let's start with Home Fund It because it addresses the single largest barrier to entry for first-time homebuyers: the down payment.
It's huge.
We have an entire generation of potential buyers who have decent income, good credit, but simply haven't had the time to stockpile $80,000 in a savings account.
Traditionally, if a young couple wanted to buy a house and their family wanted to help with the down payment, the process was an absolute underwriting nightmare.
Oh, it is incredibly tedious. In a traditional mortgage, an underwriter has to verify the source of every single dollar used for a down payment.
Right.
If the buyer's parents want to give them $5,000, they have to write a physical check or wire the money. Then the parents have to sign a formal gift letter legally stating it is not a loan.
Such a hassle.
And it gets worse. Then, the underwriter often requires the parents to provide their own personal bank statements to prove where the $5,000 came from, to ensure the parents didn't just take out a secret loan to give the kids the money.
And if you have 3 or 4 family members trying to chip in, you are suddenly coordinating a mountain of sensitive financial documents just to get a modest down payment together.
It creates immense friction. Often, buyers just give up or decide not to ask for help because it's too invasive.
So how does Home Fund It fix this?
Home Fund It bypasses this entire nightmare by digitizing and formalizing the process into an exclusive down payment crowdfunding platform.
But how is that different from just using a standard crowdfunding site, like GoFundMe?
Because standard crowdfunding sites are not integrated with Fannie Mae, Freddie Mac, or the lender's compliance department.
Oh, I see.
If you use a standard site, the underwriter still sees a massive lump sum of cash hit your bank account and demands a paper trail for every single donor. Furthermore, standard platforms take a percentage cut of the donations as a fee.
So how does Home Fund It solve the plumbing issue?
Home Fund It is an approved, compliant platform built directly into the mortgage process. Friends, family, or even wedding guests can visit the buyer's custom campaign page and donate up to $5,000 per person using a standard U.S. credit or debit card.
That's so easy.
And there are no platform taxes and there are no fees taken out of the donation. If Aunt Mary donates $500, exactly $500 goes to the down payment.
And the underwriter doesn't need Aunt Mary's bank statements.
No. Because the platform securely processes the payments and holds the funds in escrow until closing, it creates a perfectly compliant paper trail automatically.
That's incredible.
You can link the campaign to a wedding registry, share it on social media, and treat it like a modern digital transaction. It transforms the down payment from an individual struggle into a community-supported milestone, cleanly integrated into the back-end underwriting.
That is incredibly smart. It removes the friction from the bottom of the market. But what about the friction at the top of the market?
Yeah, that's the other side of the coin.
The other massive hurdle right now is high interest rates freezing housing inventory. Sellers want to sell, but buyers are paralyzed by 7 or 8% interest rates.
Exactly.
That brings us to the second tool, list and lock. How does this actually work mechanically for a seller?
List and lock allows a home seller to contribute seller concessions to secure a discounted below-market interest rate specifically tied to their property.
Okay, give me an example.
So let's imagine a seller named David. David has a house listed for $600,000.
Okay.
The market rate for a mortgage is currently 7.5%. Buyers are touring the house, but they aren't making offers because the monthly payment at 7.5% is just too painful.
Traditionally, David's real estate agent would tell him to drop the price. Hey, David, we need to cut the price by $20,000 to attract buyers.
Exactly. But mathematically, dropping the price of a home by $20,000 only lowers the buyer's monthly payment by a fraction. It doesn't move the needle enough on affordability.
So what does he do instead?
Instead of dropping the price, David uses the List and Lock program. He takes that same $20,000 and uses it to prepay the interest, essentially buying down the rate on the secondary market to secure a locked rate of, say, 5.9% for whoever buys his house.
Wait, how does he lock a rate for a buyer who doesn't even exist yet? The house is still sitting on the market.
That is the proprietary innovation. The lender, Epic Lending in this case, secures a forward commitment. They lock in that block of funds at the lower rate specifically attached to the property address for a set period, usually 60 days.
And the competitive advantage for David the seller is immediate. He gets a locked certificate from Epic Lending.
Yep.
This allows his real estate agent to advertise that below-market rate right on the MLS listing, on the physical open house flyers, and across social media.
Think about the psychological impact on a buyer scrolling through a sea of listings on an app.
Oh, it would be huge.
Every other house in the neighborhood is silently carrying a 7.5% rate. David's house is brightly advertised with a locked-in rate of 5.9%. It acts as a beacon.
Absolutely.
It drives far more foot traffic and urgency because it tangibly, immediately lowers the buyer's monthly payment far more effectively than a simple price reduction.
Now, the buyer still has to have good credit and qualify for the loan, obviously.
Yes, the buyer must fully qualify. But crucially, they qualify based on the locked lower rate of 5.9%, not the current market rate of 7.5%.
Oh, that's a game changer.
It is. This lowers their debt-to-income ratio for the application, meaning buyers who might have been denied at the market rate can suddenly get approved to buy David's house.
But there is a secondary benefit for David, the seller, that I found fascinating to know.
Oh yeah, the loyalty incentive.
Right. If David uses List and Lock to sell his current house, and then he turns around and uses Epic Lending to finance his next home purchase within a year, what happens?
Epic Lending will contribute 0.5% of his new loan amount, up to $5,000, toward David's closing costs on that next purchase. They're incentivizing the entire life cycle of the client.
If I am a real estate agent listening to this breakdown, my entire perspective on my value proposition just shifted.
I would hope so.
How does having access to tools like List and Lock, Home Funded, and the AIO change a professional's day-to-day business?
It forces an evolution from being a commodity to being an indispensable advisor. The real estate and mortgage industries are saturated.
Very saturated.
If you are a loan officer who just quotes 30-year fixed rates, or an agent who just opens doors and tells people to drop their asking price, you are entirely replaceable by an algorithm.
You're just an order taker at that point.
Yes. But if you can walk into a listing presentation and tell a frustrated seller, don't drop your price by 30 grand. Let's use List and Lock to unfreeze your listing with the sub 6% rate.
Or if you can sit down with a young couple and use Home Funded to completely bypass the down payment crisis.
Or if you can show a high net worth business owner how sweeping their $80,000 reserve through an AIO can shave a decade off their mortgage.
You are offering proprietary mathematical innovations that no one else in your local market possesses.
Exactly. You are changing their actual financial trajectory. You are solving the underlying friction of the transaction rather than just facilitating it.
You are providing strategic value that transcends a single transaction. You become a wealth partner.
Exactly.
We have covered a truly massive amount of ground in this analysis. Let's recap the core architecture of what we've explored.
Good idea.
We started by exposing the severe inefficiency of the traditional front-loaded closed-end mortgage and how it actively traps liquidity.
The locked vault.
Right. We then deconstructed the all-in-one loan, exploring how the seamless integration of an FDIC-insured checking account and an HELOC creates a dynamic financial command center.
And we examined the profound impact of daily interest computation. We saw how the simple act of sweeping idle deposits against a principal balance maximizes the velocity of money.
Right, turning your everyday checking account into a wealth-accelerating weapon.
Exactly.
And finally, we looked beyond the AIO to how strategic lenders like Ricky K. Miss at Epic Lending are using tools like Home Funded and List Unlock to dismantle the systemic barriers of down payments and high interest rates.
Empowering both buyers and sellers in a gridlocked market. The common thread running through all of this source material is the rejection of passive participation.
I love that phrase, passive participation.
Because the traditional financial system is architected to benefit the institutions holding your money. To win, you have to understand the mechanics of how interest is calculated, how capital flows, and how to intentionally direct that flow.
Which leads us to a final, provocative thought to leave you with. We spend our entire adult lives trying to increase our income. We negotiate for raises, we hustle for bigger commissions, we take on side jobs.
Right, operating under the assumption that increasing our top-line revenue is the only path to financial freedom.
But I want you to look at your bank account right now. Think about every idle dollar sitting in your checking your savings account, doing absolutely nothing for you.
If every dollar you own is supposed to be an employee working diligently for your future, ask yourself, how much of your workforce is currently unemployed?
Wow.
What if the secret to your wealth isn't just about the exhausting pursuit of earning more, but finally putting your idle money to work?
Thank you for joining us on this deep dive. We hope this exploration